So let me introduce Chris Abkarians. He's the co-founder of a company called Juno. And Chris, I don't know if you want to tell a little bit about yourself, and then we'll get into the slides. And I know that you're going to talk more about what Juno is and how it operates and how it can help people.
Absolutely. Thank you very much for the intro, Debbie. And thank you everybody who's taking some time out this evening to be with us tonight. So really quick, I want to give a background on who I am and why I'm here. So I unfortunately have too much experience with student loans on a personal basis. And 5 years ago, the way that I kind of started my experience with Juno was a story I'd love to walk you through just for 30 seconds. Almost exactly 5 years ago, one of my classmates and I were going into business school, and we were trying to compare student loan rates for ourselves. We started applying to a bunch of different places. We focused on creating a database of the quotes that we got from one lender versus the next. And then we had a few more people join us in this process and say, hey, this is a great idea. Why don't we try to map out what the market looks like so that we can give our own classmates some advice on where we can find the lowest rates. We then took that a step further and said, hey, why don't we try bundling ourselves together, saying if a few hundred of us go to the same lender, would that lender be willing to provide us with some sort of discount or better terms on the loans that they'd offer versus if we went there one by one? And so we started Juno to just help ourselves drive down the cost of paying for grad school by bundling together a bunch of our classmates and asking lenders if they would bid on our business. And that worked phenomenally well for a few hundred people. And over the last 5 years, we've been fortunate to be able to scale that up to a little over 100,000 people across not just grad programs, but undergrad programs as well. And not just the US, but a couple of countries in Europe and Canada and Australia and a few other places as well. So in general, our goal, our mission is to make sure that we can provide people with the tools and resources necessary to navigate paying for college. And over the course of the next half hour to an hour, we're going to cover three main topics. So the first topic is one of my favorites, and it's about how to negotiate financial aid award letters. It's not as relevant exactly today, but there are some key tips and tricks I'd love to leave you with that will hopefully be actionable next year and any subsequent year that you or your child are in school. The second is where we're going to spend the bulk of the conversation, and that's around how undergraduate student loans work. So as Debbie was mentioning, we'll walk through what federal student loan programs are available, what private student loan programs look like. We'll create a decision tree so that you can better understand when you would use one versus the other, what the pros and cons are. And then finally, we'll leave a few minutes at the end to talk about really what Juno is able to provide, our advice on how to access the lowest student loan rates in the market, and save as much time as anybody would like at the end for Q&A. All right, as Debbie mentioned before I jump in, if you have any questions whatsoever, please do feel free to type them out in the chat box. We'll stop periodically on each slide to see if there's any relevant questions that we can answer right away. If not, we'll save some of those for the end of the presentation as well. So the first topic we'll go into just for a few minutes is about financial aid award letters. It's now towards the end of June, and so most people, if not all, have already applied for a financial aid package from a college and received back some sort of response letter. What I encourage everybody to do is to think of financial aid award letters as first drafts and not final drafts. In a lot of circumstances, schools are budgeting for people to try to appeal these. They're assuming that some percentage of the people that they've admitted will want to make an appeal and ask for more aid. And the reality is that if you're being polite about the way that you ask for this, the school is not going to take any punitive measures. They're not going to rescind an admission just because you're asking for more financial help. On the next slide, we're going to get into some of the ways that you can go about doing this. Before we do that, the caveat I'll add is it's the end of June. It's very difficult to negotiate a financial aid award letter for this incoming semester or quarter, but there are some key things that you should know that might allow you to get more aid from the school in subsequent years. And when I mention aid, I'm not talking about more loans you can get access to. I'm talking about grants that don't have to be paid back. In effect, a discount on the amount that you have to pay to that school directly.
And can I just add, one other thing, if anything changes in your financial situation, even if it's changed now since when your student might have received a financial aid, award information, and if anything changes throughout the year, it's also an opportunity, and you should go back and make the financial aid office aware of these changes. And you can, because of the changes, ask them to reevaluate and look and get more aid. So that's like a piece of what Chris is referring to.
Absolutely. So there's two types of financial aid to keep in consideration: need-based aid and merit-based aid. So when it comes to, and here are the important things to know about each one. So need-based aid is what it sounds like. Based on your family's financial circumstance, the school might determine that you need more financial aid in order to attend. And all they can take into consideration is what you've been able to provide them in the application. If something has changed materially in your family's financial circumstance from the moment that you applied until now, it's on you to let the financial aid office know that a change occurred so that they have the opportunity to reconsider how much aid they might be able to provide. And that's true not just today, but for the next 4 years. If something changes at any point between now and when the student graduates, it is only beneficial if you take the opportunity to let the financial aid office know and ask if there's anything they can do to help you better bridge the financial gap to pay for school. Examples of that are, say somebody loses their job, say the income changes, say there's some sort of health emergency. These are all reasons why you can update the financial aid office and ask them to reconsider what that need-based aid amount looks like. Now, moving on to merit-based aid, that's really just the discount that a school gives to a student that they really want to attend because they've had a stellar academic and extracurricular background when they applied. And so if you're in the fortunate position where your student has been admitted to multiple programs and been offered money at more than one place, it's perfectly fine to let one institution know, say something along the lines of, hey, I would love to go here, but there's another place that's offering me a lot more money. It's going to be a lot easier on me post-graduation. I'm not asking you to exactly match how much aid they're providing, but is there anything you can do to help me bridge the gap? The worst you can hear is no. The best you can hear is, here's a little bit of extra money, and money that does not have to be paid back. And so what I would just reiterate here is that if you're not the one asking, the odds are somebody else in the incoming class is, and if there is any money, they'll get it and you won't. There's not a downside to asking. The worst you can hear is no, and they're not going to take any punitive action against you for politely asking. All right, I'll pause there just for a moment in case there are any questions.
Not necessarily on this topic, but I think some of the questions you'll end up answering.
Right. Then let's move on to the core of the conversation, and that's really around how undergraduate student loans work. Kim's asking a question on who at the school would be the appropriate person to ask, and that would be the financial aid office directly. Thanks for the question. So undergraduate student loans are available through both the federal government and through private lenders. There's really 3 buckets that these fall under, at least the way that I think about them. So 2 types of loan programs are available from the federal government. One is called a direct or a Stafford loan, and the second is called a Parent Plus loan. I'm not going to go through all the details of what these are on this slide, because in the next few slides, we're going to go into a lot of detail on what each of these programs is and what you need to know about it. Besides federal government loans, there's also private student loans, which are offered by banks, credit unions, and a few other online lenders. These are the main difference between these and federal government loans is that they're not from the government, and that the rate you might get offered on these can be impacted by your credit score. Federal student loans, as long as you qualify, everybody gets the same rate no matter what your credit is. And so keep that in mind as we go through the rest of the presentation. And these slides will be available later on. A recording of the webinar will be available later on, and some of the links that we'll discuss will also be sent to you tomorrow. So before we dive into each loan program, let's talk about what we're going to cover for each loan program. And so for each of those 3 types of loans, we're going to cover 8 things. And you'll have a 2-slide cheat sheet that you can reference back to if you ever have any questions about them again. So 4 of the things we'll talk about are directly financial. Is there an origination fee on this loan? What's the interest rate? Is it a fixed rate? Is it a variable rate or something else? What's the borrowing cap? In other words, how much can you borrow through this program? We're also going to talk about how you qualify for these loans. Whose name these loans are legally in other words, whose credit report will they show up on, when you have to start making payments, and what happens if you face any sort of hardship or financial difficulties. Some programs have solutions, some have fewer solutions. The first program that we're going to talk about is something called a federal direct loan. And if you ask any financial aid advisor, they would say that this is where to start if you need any money to help pay for an undergraduate education. A federal direct loan is a program set up by the government where the student directly is able to borrow a certain amount to pay for their school. The parent is not involved in this in any way. Your name is not on the loan. The key things to know about it are, 1, there's an origination fee, but it's a pretty low one. It's a little over 1%. And here's how it works. This isn't something that you have to pay out of pocket. It's not cash that you pay to anybody. But if you, using an example, had to pay $100 to UCLA for the fall, you would have to actually borrow $101 in order for UCLA to receive $100. That additional amount that's added on, that's the origination fee that the federal government is charging you for the privilege of taking out this loan. That's a relatively small origination fee. In a few slides, we'll see scenarios where it can be a larger number. The interest rate on federal direct loans is quite low, and amongst the lowest that you can find on the market. So it's 5.5% fixed for the life of the loan. And there's no traditional credit check in order to qualify to receive this loan. It's only available in the name of the child, so the parent isn't legally on this loan. And you don't have to make any payments on this until 6 months after the student graduates from school. One of the key things about this, and I'd say one of the biggest benefits of it, is that there's material protections that exist in case you face any sort of economic hardship after graduation. And so a few examples of that are, if you graduate and you're unable to afford the monthly payments on a federal direct loan, you're able to limit the amount that you pay to a relatively low percentage of your discretionary income. And so if, let's say, post-graduation, you don't have a job, then there are scenarios under this program where you can avoid making any payments at all until you do have a job again. This loan program has the most benefits and most protections of any loan program that currently exists. The main downside of a federal direct loan is simply how much money you can borrow through it. For freshman year, there's a $5,500 cap. On the next slide, we'll walk through what those caps look like for subsequent years of school and for a few different scenarios. I see quite a few questions popping up here.
Yeah, I was just trying to answer one about how much do the schools dictate how much federal direct loan you receive?
The schools do not dictate the number on how much you can borrow through a federal direct loan. No. I see some questions here on when interest starts accruing. So interest does start. I need to back up for a second. there's two types of federal direct loans. There's something called a subsidized federal direct loan and an unsubsidized federal direct loan. Most people will end up getting an unsubsidized loan, which means interest does start accruing the moment the money is sent to the school. And so if you borrowed $100 and the interest rate is 5.5%, you're charged $5.50 of interest on year one, and that just continues to grow. If you are, let's say you've submitted FAFSA, you've submitted your financial aid application, and you're deemed to have a higher financial aid need, it's possible that you might qualify for something called a subsidized federal direct loan, which means that in effect, the government is paying the interest while the student is in school. So you won't start accruing interest on that loan until after they graduate.
Just to confirm, Chris, somebody's asking, is the 5,500 the total for unsubsidized and subsidized loans?
That is, yes. Maybe to answer questions that might come up on how much you can borrow through this, let's walk through this slide right here, which is simply showing you how much you can borrow through a federal direct loan under a few different scenarios. So what you'll see on the left-hand side is a chart that breaks down the borrowing limits through this program if the student is dependent or independent. Most people qualify as dependent students, which means you can borrow $5,500 for freshman year, $6,500 for the second year, $7,500 for the third and fourth year of school. On the right-hand side, you'll see what the Department of Education classifies as an independent student. And so if you meet these criteria, then you can borrow more money through this program. If you're at least 24, married, an orphan, emancipated minor, then you're able to borrow $9,500 for the first year of school, $11,500 for the second year, and so on. And so most people will fall into that dependent student bucket. For some people, you'll fall under that independent student bucket and you'll be able to borrow more through this. And let's see if we have some more questions on it. Okay, I do see that we have quite a few questions popping up. There's a question here on why the annual limits don't add up to the $31,000 at the bottom left of the slide. That's simply because you're able to borrow some, let's say you're in school for a fifth year, you can still access a federal direct loan, but the lifetime limit on how much you can borrow through it is $31,000. There's a question here on what type of loan I said doesn't accumulate any interest until after graduation, and that is a subsidized direct loan. And so your financial aid award letter would state whether or not you qualify for a subsidized loan. Otherwise, it will likely state that you could use an unsubsidized federal direct loan. All right. I think that brings us to the first leg of a decision tree, which is pretty simple. If you or your child don't need more than $5,500 for the first year of school, then you should really just use the federal direct loan and stop there. If you do need more than that, don't worry, because a lot of people do. And there's another loan program the government has set up that's meant to help fill the gap between this $5,500 amount and what you actually need in order to pay for school. And that loan program is called the Federal Parent Plus Loan. Now, the way this works is it's a loan program that's available only for parents. The student's name is not legally tied to this loan. And so the parent has to borrow it through the Department of Education on behalf of the student's education. What you're going to notice on this is slightly less favorable terms than what you saw in the federal direct loan. And so let's walk through those. And then on the next slide, we'll talk about a few more things to keep in mind when it comes to a Parent Plus loan. So first, you might notice that the origination fee is quite a bit higher here than it was on the last slide. So the origination fee for Parent Plus loans is 4.2%, just a little bit above that. Using the same examples before, in order to pay $100 to UCLA, you actually have to borrow $104.23 on day one. The interest rate is also a lot higher than it was on the federal direct loan. So on the last loan program, we saw the interest rates 5.5% fixed. For a Parent Plus loan, it's actually 8.05% fixed for any new loans that are originated after July 1st of this year. Again, this is also a fixed rate. All federal loans have fixed rates, meaning it's not going to change over the life of the loan. There's not a traditional credit check in order to qualify, as in there's not a cutoff on what your credit score needs to be. Although on the next slide, we'll talk about a few scenarios where you could get denied access to a Parent Plus loan and what to do in case that happens. Again, this is a loan that is only available in the name of the parent. And one important thing to keep in mind is when you have to start making payments back on a Parent Plus loan. So the standard repayment, when you apply for a Parent Plus loan, or at least fill in the application that exists on the Department of Education's website, you have an option to select whether you want to start making payments back immediately, or if you want to delay making any payments until 6 months after the student graduates. You have to opt into deferring your payments until after graduation if you want that. If you're not sure and you're already using the Parent Plus loan, this would be a great time to email your financial aid office and ask them if you are opted into deferring payments until after graduation. And if you're not, ask them exactly what you should do about it, because it is getting a little bit later in the year. And so the easiest step is just to email them about this directly. The last thing I'll leave you with on this slide is there are still some federal protections in place in case you face some sort of financial hardship when it comes to paying back a Parent Plus loan. They're not as comprehensive as what exists for a direct loan, the one that's in the name of the student, but there still are some protections that exist for this. All right, I'm going to take a quick look at some questions that we got.
Yep, Chris, there's a question about the origination fee. Do you need to factor it into the amount you need to borrow, or how does that come out?
Good question. So, sorry, what happened to my video here? You should factor it into how much you want to borrow. And so if the cap on how much you can borrow through this program is the cost of attendance. And that's a number that each school comes up with on its own. Cost of attendance is tuition plus mandatory fees, plus some allowance for housing and living expenses that each school comes up with by itself. And so each school's financial aid website has a number it publishes called cost of attendance. And you can borrow all the way up to that amount. The way the origination fee would work is whatever amount it is that you need to borrow up to that cost of attendance, you would basically just have to add 4.228% to it. And that's going to be the new total loan amount, or the principal amount that you're responsible for.
So Chris, there's another question here. I don't know if you saw about divorced parents. Can they each apply for a Parent Plus loan?
So borrowing limits are tied to the student and the cost of attendance for their school for the year. But say you have two kids, yes, one parent could do a Parent Plus loan for one child, or one could do one for another. Hopefully that helps. But you wouldn't be able to borrow, let's say, twice as much for one student because one parent is taking out one Parent Plus loan, and another parent is taking out another one for the same student.
And then do you apply each year for a Parent Plus loan?
You do. And so each year you'll have to fill out FAFSA again, and you'll apply for your Parent Plus loan again. The rates on Parent Plus loans change each year. So a good example for that would be this year, a new Parent Plus loan is 8.05%. Next May, we'll find out what the rate is going to be for new Parent Plus loans for 2024. But if you take out a loan at 8.05% today, it's going to stay 8.05% until you pay it off. There is an origination fee also for each year you have to take out a Parent Plus loan. So that's just something you should keep in mind.
So I think Jessica is asking if they give us an estimate. I think she's referring to the college. If the college gives an estimate of what the tuition is, and I guess, how do they know exactly what amount they're going to need? A parent's, family's going to need to pay, and then determine how much to borrow.
Got it. So in your financial aid award letter, there's likely going to be a number towards the bottom. It states that the amount that you have to pay in order to enroll for the upcoming semester or quarter. And so most people have already received that number. I know that there are some schools, especially some West Coast-based schools, that don't start until September that have not finalized that. But you will receive a final number that you need to pay to the school well in advance of actually having to make that payment. And that's the number that you'll need to solve for when you're applying for a loan.
Right. So Jessica's saying if the college estimated 20,000, do we ask, or do you borrow for 20,000? But what if the bill comes out to 28? What do we do with the 8,000? Quite honestly, I would, you could start shopping around based on an estimate, but I wouldn't ask for a final dollar amount until you get your tuition bill, which would have the, then you'd know whether it's 20 or 28,000 that you need to borrow.
Yep. Yeah, I think that's good advice. Okay. Just two more quick things to touch on when it comes to Parent Plus loans. And so one is who's eligible for a Parent Plus loan. And it's pretty simple. It's just the parents of undergraduate students who are enrolled at least half-time at a qualifying school. The child cannot get this loan in their own name. So keep in mind that they're not legally responsible for paying it back. You can make any arrangement that you'd like with them on the side about some shared responsibility towards making sure that this is paid off by a certain date. But that's not something that is enforceable. It's not something that's going to show up on their credit report. So just keep that in mind. One of the things that some people are sometimes uncomfortable with a Parent Plus loan is the fact that the student isn't legally responsible for it. But that's just how the program was set up. The other key thing to know is how you can get a Parent Plus loan. And so, as I mentioned earlier, first you have to have filled out FAFSA. Second, each school does this a little bit differently. There's an application on the Department of Education website and on finaid.gov that's tied to your FAFSA. And so you can go through that and apply for a Parent Plus loan. Or your school's financial aid office often also has their own version of an application that you can use. And so if you are unsure, by far the best thing to do would be to email the school's financial aid office now. And I say now because it's the end of June. After the 4th of July, schools get inundated with a lot more questions than they're getting in June. And at that point, their bandwidth to respond to in detail and the speed with which they can respond slows down. And so if any questions you have, the sooner you can ask them right now, the better the quality and speed of your responses will be. Now, I mentioned that there's not a traditional credit score or credit check when it comes to Parent Plus loans. That's true, but there are a couple of reasons why the Department of Education states that they might deny somebody access to a Parent Plus loan. So what I pulled on the slide is just explicitly what comes off of their website. They claim that if you've had a recent bankruptcy, a large debt that's more than 90 days delinquent, or a recent wage garnishment or tax lien, they may deny you access to a Parent Plus loan. If that happens and there's no way to fix it, then you do have one option left, which is to request that your student gets access to borrow more money through the federal direct loan program. And so if a parent is denied access to a Parent Plus loan, then the student can borrow as much as an independent student can from a few slides ago. Maybe to flip back to that just so that you can see exactly what I'm talking about. If you've been denied access to a Parent Plus loan, tell the financial aid office that you want the student to be able to borrow $9,500 for their freshman year through the federal direct loan, or $11,500 for their sophomore year. I'll pause there just in case there's any more questions on this.
Somebody's asking about if a parent takes out a loan after graduation, can you combine the loan that your child has become responsible for payments? So really good question. And you're probably not going to like the answer.
Would you like to provide it? I think unfortunately the answer is simply no. The Parent Plus loan just becomes a loan that only exists in the eyes of the law and credit bureaus in the name of the parent directly. And there's no way to add the student onto that.
That's why this decision is so important now.
Yeah. Okay. I see a few more detailed questions that are great. I'm just going to save those for the end to make sure that we're able to wrap up in time. So if you don't mind, I'll just keep going forward and we'll come back to these in 10 or 15 minutes. So we've talked a lot about the federal student loan programs and what they cost, how they work, with one of the key things being, no matter what your credit is, everybody gets the same rates from the federal government. For some people, that's fantastic. For some people, that's not so great. Private student loans are an alternative to federal student loans. And we're going to talk about some of the key details about them right now. And then we'll dive into what are some of the reasons why you might consider using these over a Parent Plus loan or another federal loan. And so private loans, for the most part, don't have origination fees. None of the companies that Juno has ever partnered with have an origination fee. The largest student lenders who are out there today, as far as I'm aware, do not have origination fees. The interest rate that you get charged on these, though, does vary based on your credit. And so for some people, it's possible to get lower rates than what you get through a Parent Plus loan. And for other people, they won't be able to find a rate that's better than what they get through Parent Plus. Similar to Parent Plus, you're able to borrow all the way up to the cost of attendance. So as that quick reminder, that's the fully loaded cost of what it'll attend to go to school for the year. That includes the tuition, fees, housing, and some other living expenses. Private loans are a little bit more complicated than federal because there's a couple of things you're able to choose between. So one, you have the choice of going with a fixed rate or a variable rate with most lenders. I'll say candidly, of the thousands of people that we speak with each year at Juno, the vast majority go with fixed rates anyway. And when you start making payments on private loans, it can also vary. When you apply for one of these, you typically have a choice of up to 4 repayment types. On the one extreme, you can choose to defer making any payments until 9 months after graduation. And on another extreme, you can choose to start making full principal and interest payments, or opting into something called immediate repayment from day one. What that means is if you are going to school in September and you choose a 10-year immediate repay loan, that means that 10 years after the money is sent to the school, you should be done paying for the loan. You'll be paying off the interest while the student is in school. Most people opt to defer making payments until after graduation, or they select another repayment plan that might allow them to just pay off the interest while they're in school, or to pay some smaller amount or pay off partial interest while the student is in school to avoid a lot of interest accumulated. Another key thing to know about private loans and federal loans is that there's typically no prepayment penalty, meaning if you took some money out now and in 3 years, you decided you wanted to pay the whole thing off early, you can do so without any penalty whatsoever. The last two things to touch on private loans. One, you typically need at least a 650 FICO score in order to qualify from most lenders. It varies a little bit from one lender to the next and from year to year, but just keep that in mind. And unlike federal student loans, these don't have protections in case something happens to you. So you're not going to get, let's say, income-based repayment or loan forgiveness programs that a federal student loan might be eligible for. But if you have great credit, you might end up getting charged less for the loan in the first place. So it's a trade-off that you have to take into consideration. And just to wrap it up on private loans, three just topics I'd love to cover. So one, when should you consider a private loan? I'd say the most important thing to keep in mind is that I wouldn't look at these until after a student has used the federal direct loan. That federal direct loan has lower rates than what I'd say 90+% of people will find on the private market, and it has a lot of protections built in. So I would make sure that you use that before you even consider looking at a private loan. And then the next step of that decision tree is to compare what a Parent Plus loan for you looks like to what a private student loan rate might look like. And so the two reasons why you might consider using a private loan in place of a Parent Plus loan is, one, if you're getting quoted lower rates through the private market than what you're getting quoted through the government. And two, if you just really want to make sure that the student is jointly legally responsible for paying off the loan. Either of those scenarios are pretty common ones why we hear people choose to use a private loan instead of using a federal student loan. But it does largely come down to just the economics and personal preference and risk. How you compare your private loan options is also really important, because most lenders at this point, or a lot of the largest ones, give you the ability to do what's called a soft rate check or a pre-qual. And what that means is that you're able to get some sense for what rates you might qualify for without having to do a hard pull on your credit. And so one of the places I recommend that people look at is a company called Credible. It's at credible.com. We'll walk through that in a little bit more detail in a few minutes, but it's also accessible through the Juno website. It allows you to check what rates you might be eligible for across 7 to 8 lenders, depending on what part of the country you live in, without doing a hard check on your credit. So you can think of that as the easiest, fastest way to understand what options are available to you without impacting your credit. And it is in your best interest to learn what options are available to you to make sure that you're not throwing money away for no reason. All right, I'll pause here for a few more questions.
Good question about if the family decides to do a parent loan, can they consolidate loans and have their student take on the financial responsibility after they graduate?
Great question that gets really detailed and in the weeds depending on different scenarios. So I can't honestly provide a really good general answer on that because I'm less of an expert on consolidation than I'd like to be. So I don't want to misspeak here. And some of the rules around loan repayment are, at least there's a lot of new rules that have been proposed.
I think they're just referring to private.
For private. Okay, sorry, what was the question again then?
If we decide to do a private loan, can we consolidate loans and have our child take on the loan after graduation?
Okay. Great question. So the vast majority of private loans are co-signed, meaning the student and the parent are both on that loan from day one. So you apply together. The loan is priced based off of the parent's credit score, not the student's, but the student is attached to that loan from day one. And so short answer, yes.
So I think, and what Chris might have been referring to a little bit is, and I don't know from the question if the person is asking, but it is more difficult and it's more complicated, and you'd want to really think it through about you can't combine your federal loans with a private loan. So that's one thing. And then the second thing is you can consolidate just the public loans, but there are some issues that you want to really understand, and it's too complicated to go into detail now, but just wanted to kind of put that out there.
Yeah. But thank you very much for the questions.
This is actually the second question that we've had about debt to income ratio. Somebody's asking that they are married, have two incomes, and want to co-sign for their son for a private loan. Will they be using both incomes to determine the debt to income ratio?
Great question, and it can vary by lender. And so there's not a universal answer that I can provide, but at this point, I've had a lot of insight into how many lenders underwrite their loans. And often the way that I've seen it done is sometimes there's a debt to income ratio that's used as a cutoff for qualification. Often it's just kind of like a threshold or a minimum income that somebody needs regardless of the loan amount. It changes depending on lender. So I don't have a universal answer.
But, these are quite, I mean, we're trying to answer as many questions as we can, but absolutely this type of a question, I would, call up the lender directly and ask them how they do it. And they'll be pretty straightforward.
Yeah. Amy, do you take student loans in a single lump sum for the 4 years of college, or do you take them on an annual basis? It's a question we got a lot, and it's really important because you should only take it 1 year at a time. You don't take 4 years worth on day one. Two reasons for that. One, you actually can't. As I was saying earlier, the amount you can borrow in a given year is up to that cost of attendance number. And so you can only take that cost of attendance number for this year. That number might change for the second, third, and fourth year of school. Two is, let's say you probably wouldn't want to, because you'll be accruing interest on a larger balance for longer than you need to. And so the money, you basically, for both federal and for private loans, you start accruing interest on these loans at disbursement, which means when the money is sent to the school. And so if you can avoid the money being sent earlier, if you don't need it, then you're going to be avoiding having to pay interest on that loan unnecessarily.
So there's a question, do I get a better rate being a co-signer for my student or taking out the loan in the parent name only? And I don't know, but we can answer both ways. And when they're referring to take out in the parent name only, if they're referring to a private loan where they co-sign versus a parent plus loan, or a private student loan versus a private parent loan.
So the way I'll start that answer is by saying, when it comes to private loans, there's two types of private student loans for undergrad. One is a co-sign loan, and one is what's called a parent-only loan. So a co-sign loan is the student and the parent are both attached to it. The parent loan is almost like a replica of the Parent Plus program. It's a bank that's giving a loan directly to the parent to pay for their student's school, but the student isn't legally attached to that loan. It's not on their credit report. The vast majority, over 90% of private loans that were originated last year were co-sign loans. And so private parent loans are a much smaller market. A lot fewer of these exist and happen in the first place. In general, the rate on a co-sign loan is a little bit better than a private parent loan. That is not always true. But I had this discussion recently with some folks who were looking into this, and the conclusion was the reason why you'll sometimes get quoted a lower rate on a co-sign loan is because technically there's two people who are legally responsible for.
I've been told the same thing from lenders. Yeah. So just to back up your answer.
Yeah.
Another question about somebody wanting to buy a house, and will the Parent Plus loan still be a good option, or will it affect my home loan?
So any loan that you're taking out for school is going to show up on your credit report. And so when a mortgage lender looks at your debt to income ratio, which will impact how much mortgage you can afford, that student loan payment will be taken into consideration. And so whether it's a federal loan or a private loan, if it's for the same amount, they're both going to impact, at least have some impact on how much of a mortgage you can get.
Chris, there's a question about, I guess, when repaying loans, how much does of the payment, does the extra go towards the principal or interest?
So when you're repaying a loan, you can actually choose where you want the incremental amount to go to. And so if you wanted to go directly to the principal, you can choose to do that. So when you start repaying a loan, which you'll typically have an account that opens with what's called a servicer. So whether you're borrowing from the federal government or from most private lenders, they typically outsource management of that loan to a relatively small number of companies that are pretty big and well known. And so you'll log into a dashboard there, and that's where you'll connect your bank account and start making payments. And that's where you can select if you're making an additional payment or something on top of what you owe, to have that go straight to the principal.
So Chrissy, there's a good question, and I don't know how many people might be in this situation. Somebody is saying that they actually already applied and accepted and signed for a loan. They realize now that they might not have shopped around enough. The money has not been dispersed. If they can find a better loan, is there any way of getting, or a different loan with a better interest rate? Is there any way of getting out of the first loan?
Absolutely, yes. And so this is something I actually ended up doing a couple of years ago for myself. There's a scenario where I'd applied for a loan, gotten a certain rate. 6 weeks later, I realized that there was a much cheaper one available somewhere else. And I wanted to figure out what to do. And so what you can do is, I'd say step one, make sure that there is a better option out there for you and that you've locked in that rate. So don't cancel your existing loan, which I'll get into in a second, until you've applied for and have been approved for another loan that is cheaper. Once you've been approved for that cheaper loan, then call the financial aid office and tell them that you want to cancel the first loan that you sent over to them. And just make sure to do that before the money is dispersed, before the money is actually sent to the school. Otherwise, there'll be a lot more complications. But if you follow that order of events, then yeah, there is no issue.
How long does it take to get approved?
Good question. So for most people, it typically takes somewhere between 1 and 2 business days to get approved for a private student loan. In some cases, especially if the cosigner, meaning the parent, is retired, there might be some additional paperwork that is required that could extend that by a few days. Post approval, what happens is this. So it might be helpful if I just spend 30 seconds walking through the application process for all private student loans. So what happens is you might do a rate check. So you'll get in a few minutes an example of what rates you'll qualify for. The next step is it might take another somewhere between 15 and 30 minutes to submit a full application. And when you submit a full application, that's when a hard credit check occurs. And that's when you'll see rates that the final rates that you'll qualify for. In most cases, the rates that you saw from the soft check will match what you get from the hard check. And so let's say you submit that application, they do a hard credit check, within 1 or 2 days, you're approved. Once you're approved, the rates are good for 30 days. And so they're locked in for the next 30 days. During that window, you can choose to sign that loan or not. If you sign it, that's basically saying, yes, I want this money to be sent to the school at a later date. Then the lender has to certify that loan. What that means is the lender contacts the school and asks, is this person in the incoming class? Is the amount they want to borrow less than or equal to the cost of attendance? And that process, how long that takes, varies depending on how quickly the financial aid office is able to process a bunch of different loan applications. It can be extremely quick. It can take 2-3 weeks in some circumstances. But once that is over, then basically the only step that's left is for the school to request that the money is sent. And that typically happens on the same day for all loans for a particular school. Schools have something called a tuition due date. That's the date by which you have to pay them. It's also the date that they request that the lenders transfer whatever loans people have applied for and signed to the school. And that's the day that you start accruing interest. In general, we tell people that if you're applying 30 days before that tuition due date, you're going to be completely fine. If you can do it even earlier, that's better. If it's less than 2 weeks before that tuition due date, that's when I would start to get a little bit nervous.
So Chris, there's one more question, and then you should probably go on and explain how Juno can help everybody, but this is a really good question. Somebody's asking, they've gotten a lot of marketing mail, about loans. On the marketing material, a lot of them say, loans, you can get a loan with interest rate as low as, 4 point something percent. Are those rates really achievable? Who receives them? Or are they just like pure teasers?
Fantastic question. So they are achievable, but in somewhat rare circumstances. So when a lender shows you, when they do their advertising, they almost always show either rates starting at some percent or rates from X to Y percent. And whenever they show that, by law, a certain percentage of people who apply have to qualify for that lowest rate. But what lenders will tend to do is make it so that 4 point something percent is typically associated with a 5-year loan that you have to start paying back right away. Whereas most people want to take longer to pay off their loans and want to delay having to make payments until after graduation. So if you are in let's say solid financial shape and you can afford to start making payments back immediately right now, then and you qualify for those teaser rates, in a lot of cases it's a fantastic outcome. We're seeing teaser rates from a lot of lenders, meaning when I say teaser, I mean that lowest rate that you can actually qualify for, that are currently cheaper than US government debt today. And so if you do qualify for that and you can pay it back, I would at least consider it.
So those lowest rates that you see, just to kind of emphasize what Chris is saying, is going to be for the person with the best credit. And as Chris mentioned, you've also minimized the risk that you are that minimize how risky you are as a borrower to the lender, because you are taking the shortest amount of time to pay it back. You're starting to pay it back immediately. So all of those quote features of a private loan, those decisions that you make impact the rate that the lender is going to offer you.
Yeah. And I see one more question here I want to answer before I just flip to the last few slides and back to Q&A. It's let me just answer this directly. You can borrow less than the cost of attendance for a federal loan or a private loan. You do not have to borrow that full amount. So if you, using an example in a question that we have right here, someone is asking, if cost of attendance is $50,000 and I have $25,000 in savings, can I only borrow $25,000 through a private lender or federal? And the answer is yes. You can always borrow less than the cost of attendance. You do not, but you just can't borrow more than that in a given year. All right, I'll try to end this portion of it in the next 3-ish minutes so that we stay on time, and then I am available for all questions after as well. As I was mentioning at the top of this call, I started Juno with one of my classmates 5 years ago to help our classmates get cheaper student loans. And we turned that into a company called Juno. Super appreciative of everybody who's here this evening to hear us speak about it a little bit. We've grown Juno to a little over 100,000 families that are using it to help identify the lowest rates and the best terms that are available across the private student loan market. And what that's led us to do is the following. So if you sign up on joinjuno.com, and we'll send a link to this as well tomorrow, there's a really simple process for you to go through. You only have to answer a few questions. Joining Juno is free. We do not take your payment information. We never will take your payment information, and we'll never charge you. Our goal as Juno is to get as many people interested in the process of what we do as possible. And so when you go to joinjuno.com, you only have to fill out a few questions about yourself and your student, primarily what school they're going to and what their graduation year is, so that we can best match you with the loan option that we think is the best fit. Once you've filled out that 2-minute sign-up process, you'll be presented with a screen that looks like what you see in front of you right now. And so for this summer, what we're able to provide for undergrad is really one of two options. So when you get to that page, on the left-hand side, you'll see an offer from our preferred lender. This is when I'm saying we aggregate demand amongst thousands of people, and then we reach out to a bunch of different lenders asking who can provide something better to this group than they can get on their own. Our preferred lender won that competition. And so when you look on the left-hand side, that means you'd go to a company called Earnest that we've worked with for a while now. If you sign a loan through Earnest, we're able to give you 2% cash back. Think of that as the opposite of an origination fee. And the way that would work is if you're taking out a $20,000 loan, we would cut you a check for $400. If you find a lower rate from a long list of eligible competitors, we have a really simple process where we can match that rate and increase your cash back from 2% to 3%. This whole thing has been set up so that we make it a no-brainer to try to use this option for anybody who's willing to. Next slide, I'll walk through exactly how that rate match process works. On the right-hand side of the screen, and what you'll see once you log into your Juno account is basically a link to a company called Credible that I was mentioning a few slides ago. And what that allows you to do is to do a soft pull and check your rate from at least 7 lenders, depending on where you live, so that you can get a better sense for what rates you might qualify for, and to make sure that whatever we're putting in front of you is actually as competitive as I'm saying that it is right now. How that rate match process works is as follows. So step 1 is to shop around. Whether you're using Juno's links or you're responding to one of those mailers or you're looking something else up, if you're considering private loans, I highly encourage people to shop around, because sometimes they'll be surprised by how different the rate you might get quoted is from one place to the next. Step 2, you'd be doing me a huge favor if you would check what rates are available to you through Earnest using Juno's link. So the link that's available on your dashboard. If you found a lower rate somewhere else, that's from an eligible competitor, which again is all the major players plus a lot of smaller ones, then we have a simple process where you just email hello@joinjuno.com. Somebody on our team will make sure that you are comparing similar loans, so that you're comparing a 10-year fixed rate from one lender to a 10-year fixed rate from another lender. And then we work in the background to make sure that Earnest changes the rate that you qualify for and matches it to that lower rate. And for going through that process, we increase the cash back that we give you from 2% to 3%. If you have any questions whatsoever about any portion of this, our whole team is available all summer to jump on Zoom and either walk through applications with you or to answer any questions that might exist. I see a comment that the slides are not changing as I'm mentioning. Debbie, do you see the slide that says how the rate match process works?
Yes, that I see. Yes.
Got it. Okay, there's a question here from Jennifer on when I say shopping around, do I mean doing soft credit pulls or actually applying and getting an exact rate? So for shopping around in general, I mean just the soft check. As I was mentioning before, the vast majority of the time, what you get quoted on a soft check and a hard check is going to be the same number, unless there's something very different that shows up in your full credit report than what was available on a soft check. So for shopping around, you can stick with soft checks. To do a rate match, you would have to do a hard check and be approved for a lower rate from another lender.
And I'm kind of like combining a lot of questions that people have asked, through the night. You can start going to lenders or Credible, or Earnest through the link on Juno's dashboard and apply for a loan. You can put in a dollar amount, and then you can get your interest rate back. And then if you have to adjust, and maybe correct me if I'm wrong, Chris, is it really more recommended to put in a slightly higher amount of what you might need to borrow? And then before it is actually dispersed, you can reduce the amount that you might want to borrow. It's harder to increase the amount. But my point is you don't have to like wait to the last minute. You don't have to wait even if the tuition bill hasn't come yet. You should probably start finding out what type of interest rates you're going to be offered.
Exactly right. Especially if you're not doing a hard pull on your credit, understanding what's available is just going to be a benefit to you.
Right. So I put a link in the chat for joining Juno, but you'll also be getting an email tomorrow with like a summary of these steps, this information. And regardless, the most basic thing is to create an account with Juno. As Chris said, it is free. You're just kind of creating the account so that when you have what you think your best offer is from shopping around, you can then go bring it to Juno and see if they can match it or do better.
The quick recap before I answer a handful of more questions is, step one when it comes to paying for college, in my opinion, is to reduce the amount that you have to actually pay out of pocket. And so whether it's today or a future year of school, take the opportunity to ask for more aid. If there's been any change in financial circumstance for a family, update the financial aid office, whether now, next year, or the year after, about that change so they have the opportunity to consider having you pay less for school. If you need money after the aid that you've been provided, start with the federal direct loan. It has great rates from the federal government. It's in the student's name. The only downside is that there is a limit on how much you can borrow. If you need more money than that, don't worry, because the vast majority of people that we speak to do need more than that. And that's where you compare a Parent Plus loan to a private student loan. And if you're looking into private student loans, I would just ask you to look back again at that Juno rate match program and at the experience that we've been able to provide. If you have any questions at all about that whatsoever, you can always use the help button on our website or email hello@joinjuno.com, and somebody will typically get back to you within minutes. So with that, I'll just flip it back over to Q&A and see if there's anything left that we should go over.
I just want to add one other thing. This is, I think, Chris, the third year that we've been working together. So I just want to mention that this isn't the first year that Juno's been around. It's not the first year that we've worked with them. And so I know that families in the past few years, many families have gotten great rates by doing exactly what we've talked about tonight. And their great rate, ultimately comes through with Juno. So just want to put it out there that this isn't, a fly-by-night idea. This is definitely something worthwhile, and a good process to follow as you're trying to find the best rate that's out there for you and your family.
Thank you very much for that, Debbie. I see a question here from Susan on if you take out a loan for 4 different years of school at different interest rates, at the end of 4 years, is it going to be consolidated into one loan and one payment, or is it going to be 4 separate loans? The short answer is that it's going to be 4 separate loans. There are ways that you can change that after graduation. So if you're using federal loans, let's say for all 4 years, there's a program called consolidation where you can combine all of those federal loans at the end of the 4-year window into one larger loan with a single payment. That's a lot easier to manage. If you're using private loans at the end of that window, then you might be able to refinance those. And so if you got 4 separate private loans, a common tactic people will take is to attempt to, say post-graduation, get a new loan from one of the private lenders that pays off all of their old loans, but again, leaves them with a single payment. Depending on what the interest rate environment looks like 4 years from now, the amount that you can refi for, the rates that you might qualify for when you apply to refi could be lower than they are today. They might be the same and they might be higher, but there are options for at least combining those loans together and potentially saving a little bit of money.
So somebody asked, can a grandparent be a cosigner? I answered the question, yes, a grandparent can. And basically anybody can be the cosigner on your student's loan. I mean, I'm not sure how many people would agree to it, but I'm just saying it. A lot of times I've seen students, depending on the family situation, where they've asked an aunt. So it doesn't have to be a parent for private loans. It does have to be the parent if you're going to take out the Parent Plus loan.
I see a question here from Jennifer that's related to death and disability discharge. And so the question directly is, what happens to a private cosign loan in the event of the death of the cosigner or the student? This is something that varies depending on lender. And so first, I would make sure that you call the lender's customer service line to ask them about what happens in the case of death or disability. Most lenders should have this very cleanly laid out on their website already, but many at this point do discharge the loan amount in the case of not just death, but a significant medical disability that occurs later.
So Chris, is a good question. Hadn't really thought about this. Steph is asking, she's got 2 college students, and this would apply, I guess, also if you parents, they had twins or multiples. For Juno's purposes, do they create one Juno account? But how do they handle it if they want to, they're taking out multiple loans?
Fantastic question. For right now, it's easiest to make 2 separate accounts. The reason being, we will send communications and updates based on what you filled out in your profile. Right now, we only have 1 profile page per person. And so if you fill it out for the students in undergrad, then you might get different communications and different offers than if you fill out one for yourself for your master's program.
Okay. Well, thanks, Chris. I think you answered a ton of questions, provided a lot of good information. I think people really got a good overview of the federal loans, private loans, the questions they need to ask themselves about which direction they want to go. At a minimum, I think hopefully people have gotten the idea that they need to start, and they need to start finding out what interest rates they can potentially get, start figuring out how much they want to borrow, create a free account at Juno. These are all basics. And then in the next few weeks, it's all going to become real when the tuition bill comes and you're going to have to make the final decision and hopefully, get a great rate match through Juno.
Absolutely.
We will be sending a link to this recording tomorrow, so you can watch it again. And as you have more questions, you can contact Juno, or you can send me questions as well at Debbie@Rhodes-College.com.
Thank you, everybody, for joining. Thank you very much for all of the great questions, and special thank you to Debbie for being an amazing host as always. Really appreciate all the content you put out and all the people you help, and for letting us be a part of it.
Absolutely. Well, thanks, everybody, and let us know how we can continue to help.
All right. Thank you.
Take care. Bye.